Hi, my name's Abbey Phillipps and welcome to JMM Insights. Today I'm speaking with Greenwing Resources, ASX code GW1, an Australian critical minerals company with a diversified portfolio spanning lithium, graphite, and polymetallic assets across Australia, Argentina, and Madagascar. Joining me today is Peter Wright, Managing Director of Greenwing Resources. Peter, thank you for joining me.
No problems, Abby. Nice to see you again.
For those who may be new to the company, could you start by telling us about what you do and the strategy you're pursuing across the asset portfolio?
Oh, look, as you said, we've got a diverse portfolio. Our primary focus and I suppose core capability is in battery metals, in lithium and graphite. The board that we have all has very significant lithium and graphite experience. We've got three pretty advanced assets. We've got a mine that we operated in Madagascar for 2 years. We've a really substantial resource. It sits under a mining lease. We have a really interesting project in Argentina in the Lithium Triangle. It's a bit early stage, but strategically, it's a substantive asset. It's a salar that we own all of. We're only one of four companies that can say that. There's only 23 salars in the Lithium Triangle, which we've got one of them, and a really substantive broad tenement package surrounding it. And then we've got this polymetallic legacy asset, Q River, which we can speak about as we step through this. But we've progressed that to a point over the past few years where it's at a pretty compelling juncture of its development. And we announced last year that we intend to spin that asset out over the course of the year, which we're contemplating various pathways for that at present.
And Peter, Greenwing has exposure to several key commodities linked to the electrification and energy transition. How do
Yeah.
lithium, graphite, and polymetallic assets fit together within the broader strategy?
Well, I suppose they don't, which is why we're looking at spinning out the Q River asset. But in terms of graphite and lithium, so ever since I've been looking at resource assets and resource markets, I've always been really attracted to enduring dislocations between supply and demand. A very long time ago, I was an equities analyst and looking at the emerging demand for iron ore and what you could see were going to be severe deficits, and to a lesser degree coal. And started to look at lithium sort of in 2010, went to work with a company called Altura, and you could see that there was going to be a massive deficiency in supply. And I still see exactly the same thing playing out in lithium and to a lesser degree graphite, especially lithium though, over the next couple of years. For all the mayhem of the last 15 years, the market's added 2 million tonnes of lithium, and the low end estimates have us needing another 5 million tonnes in the next 4 years. And I see that as being problematic from a supply side. And I think how that will manifest itself is we'll go back into deficit in lithium if we're not there already. And what has been a challenging couple of years in the space will get a lot easier. Graphite has similar dynamics. It's not as big a market, but what attracts us to graphite in particular is the concentration of supply. 90% of natural graphite is exported by one country, which is China. China has threatened multiple times to withdraw that supply from the market. If they did that, there's more graphite in a lithium-ion battery than lithium. That would cause severe disruption to vast swathes of developed economies. We sit there with a mine, not buried rocks. It's a mine. It's produced everything from super jumbo concentrates through to fine flake graphite. It's a very large resource now, 62 million tonnes, a resource that has been proven to be commercially viable and technically viable. It's no mean feat to produce those concentrates to specification and to have qualified into the US, Europe, and other jurisdictions. And then we have the Q River asset, which we've spent a lot of time and resources on the last few years. It was not in a position a couple of years ago to contemplate putting in its own entity. It certainly is now.
And just further on the Q River project, what makes
Yeah.
this asset particularly compelling at this stage of development?
There's a number of things. And I took over the day-to-day running of the company in May 2023 and pretty extensive review of the assets and had a really good look at Q River. So Q River sits under a mining lease. It is adjacent to an operating mine. It's 12 kilometres from another operating mine. Both of those mines have processed Q River ore previously. But what's been really interesting over that journey is, when last year that work accelerated, we produced a scoping study, which really robust results. We produced a scoping study, an updated resource, highlighted exploration upside. But what's unfolded in parallel the last few years is the emergence of Tasmania as a jurisdiction for data infrastructure. And we began to think, well, what would the suitability of Q River be to host this sort of stuff? And so Q River it's an advanced site. It's zoned. There's several cleared areas. There's a potable water endowment there of 240 megalitres, which the largest data centres need that. There's a substation immediately adjacent to site with a 30 megawatt capacity. It's a low ambient temperature. It's really cold there. The highest mean temperature per month at Q River is 12 degrees. It snows there pretty much every month of the year. It's cold, which you need for data infrastructure. So we began to articulate a pathway for Q River where we would mine the open pit. There's about 600,000 tonnes there of gold, silver, and copper rich ore. Process that either next door at Helier or up the road at Rosebery. That was delivering the best part of $65 million free cash flow. It only takes us about a year to mine that material and then take that cash flow to leverage into what we think is a pretty exciting opportunity to develop data infrastructure there. That sort of asset is not a natural bedfellow of lithium and graphite. So post 2 or 3 years of really hard work, we think we've got the Q River asset into a point where it belongs in its own entity. Importantly, we've got really good stakeholder relations with the relevant government departments in Tasmania. We've discussed this with them. We've let them know that this is the direction we want to take the asset. So, it's not a surprise to them. We've got to work with them if we want to do this.
And just looking deeper into the scoping study that highlighted a potential low capital pathway to cash flow
Yes.
at Q River, how
Yeah.
important is that type of optionality for the company?
Oh, well, enormous. We've had like a lot of our peers, we've had a pretty humbling 3 years. We're a fraction of our market cap, so we have to be really careful with managing our equity base. So lower capital intensity pathways to cash flow are fantastic for companies like ours. So it's Q River's an existing mine site, and where we're contemplating taking the ore from is an existing open pit. It only shut down in 2013 due to low metal prices. The ore we're looking at is rich in gold, silver, copper, and zinc. The road haul is either 3 kilometres or 12 kilometres. These aren't massive capex spends. It's existing infrastructure. So, and when you're contemplating using someone else's processing facilities, that's not our capex problem. It's almost an earth-moving exercise for us, which we're looking at and which delivers a really substantial cash flow.
And Greenwing also operates the Graphmada mine in Madagascar.
Yes.
How does having a producing or near producing asset influence your approach to growth?
Well, again, it comes back to, look, in an ideal world, I'd love to be drilling at Graphmada. I'd love to be drilling at San Jorge this year. But we're a $20 million company at the moment. We're not $140 million where we were. So issuing equity or a broad issuance of equity has an effect and a dilutionary effect. So you've got to manage that with a cost benefit analysis. The last few years at Graphmada, we've taken the resource from 14 million tonnes to 62 million tonnes. We think that the next step for us is to table a scoping study looking at a much larger rate of production. So whilst we were doing 6,000 tonnes over stage one, we look at 60,000 tonnes in stage two. And the particular characteristics of the Graphmada ore were allowing us to do 45% large flake and above, which is where you make most of your margin, and 55% fine flake graphite. We think with the previously highlighted strategic issues with the graphite market, if you can articulate a picture at Graphmada where you have a pathway to materially increase volumes of these in shortage concentrates that that likely manifests itself in attracting a strategic investor to help with the development of the asset.
Then turning to South America, the San Jorge lithium brine project adds another
Yeah,
layer to the portfolio. What
it does.
attracted Greenwing to this project and region?
Oh, look, again, it's looking at long-term supply and demand imbalances, and what I think are already fragile fundamentals for lithium in particular, I think is about to be absolutely shattered by um, the investment coming in data centers and AI infrastructure. Nearly all of these developments are contemplating significant battery energy storage structures, which none of that is in the current demand picture for lithium. And as I said before, I still think it's going to be pretty challenging for the market to, get to 7.5 million tons by 2030. If you then add another dimension to that demand coming from battery storage for data infrastructure, it's only going to make that supply problems more acute. So when we looked at South America, we thought, the Lithium Triangle is to lithium what the Pilbara is to iron ore, what the Bowen Basin is to coking coal. It is the best jurisdiction on the planet with respect to the Pilbara with spodumene, but it is the best. It's where most of the money has been spent. It's where most of the supply comes from. We found at a particularly low ebb of the lithium market, one of the only independent salars left in the triangle. We came to an arrangement to buy that. We conducted an initial drilling campaign in the peripheries of the salar, so we're pretty successful. We got an initial 1 million ton resource, but the upside there, we have done a lot of surface work. The mineralisation is extending to the lease boundary. It's a 38,000 hectare tenement package with a 2,800 hectare salar, which we own all of. And if you think about what I think is a context for tightening supply and scarcity of quality assets, I think as that begins to manifest itself over the next couple of years, that San Jorge will really increase in value, which we're already starting to see that happen now. A lot of, well, not a lot of, we're getting an emerging, level of inquiry at an asset level for the project.
And recent capital raisings have strengthened the balance sheet.
Yeah.
How well positioned is Greenwing to execute its near-term plans across the multiple projects?
Yeah, well, look, to be pretty frank, you probably don't need a forensic accountant to see that with our last quarterly that we're sufficiently provisioned for the medium term. There's a number of levers that we can pull, be them asset sales. We're continuing our program of selling non-core equipment in Madagascar. But look, to execute what we want to do over the next 12 to 18 months, will require further investment, and we're contemplating the various sort of pathways to achieve that.
And with several assets at different stages, how do you
Yeah.
prioritize capital allocation and management focus?
Well, look, you have to be pretty disciplined. We have, I in particular have a pretty strong view on what the assets are worth. It was only 12 months ago that San Jorge was under option for $200 million US, effectively. It's best part of 30 times our current market cap. So when you issue equity, that limits your upside. You are diluting existing shareholders. So need to be really careful how you do that. So I think the most logical sort of pathway for our funding is looking at partial asset sales, selling strategic stakes in assets. I think the best way to do that is to highlight the potential of both assets, San Jorge and Graphmada. Hence, we're doing scoping studies this year on both assets. Graphmada in particular, we have all the production data, all the hydrology, the processing data. We qualified into the US, into Europe. We sold everything from super jumbo flake concentrates to fine flake concentrates. There's a lot of information there. All the infrastructure is there. It's 3 kilometres off the highway and 100 kilometres from the country's only deepwater port. It's not that large of a process to come up with an initial study. San Jorge, a little bit less information, but we've got the 1 million tonnes. The porosity is an outstanding 7.5%. We've done some initial processing test work. It was extremely encouraging. So I think for us, 2026 will be a year of recovery in industrial metals markets. And the job for us, I think, is to highlight or put some real empirical data on what the opportunities can be at San Jorge and Graphmada, and in parallel conduct a process for Q River, with a view to delivering the value that we think is inherent in the portfolio for our stakeholders.
And I guess diving a bit deeper into this here. So market sentiment around critical minerals can shift quickly. How do you balance, yeah, how do you balance advancing projects while remaining disciplined through commodity cycles?
Well, I think it comes back to your core view on the value of the assets. At present, like most of our peers, we're capital constrained. It would cost us $7 million to go out and drill a follow-up drill program at San Jorge. That would involve, in proportion to our current market cap, a really broad issuance of equity. So we're reluctant to do that at present. So you need to find ways to add value to the projects with minimum equity impact. If your view is over the long term, these assets are severely undervalued, that we think that lithium in particular improves over the course of the next 12 to 18 months, and you can issue equity on much more favourable terms, over that 12 to 18-month period. So, yeah, as you say, it's a balancing act. There are a series of things that we can do this year that add, I think, substantial value, and all of those sort of focus around initial economic studies on both projects.
And then finally, looking ahead over the next 6 to 12 months, what key milestones should investors be looking out for as Greenwing continues to evolve?
Look, I think the delivery of both studies for San Jorge and Graphmada, further information on the pathway for Q River. It is exciting what's going on at Q River. There's a stage one opportunity with really low capex to get substantive cash flow out of gold, silver, copper, zinc ores. And then there is a legitimate, it's not shameless pandering to the thematic. There's a very legitimate foundation to assess that site for data infrastructure in an emerging jurisdiction. Everyone's seen Firmus. They're only sort of 80 kilometres away from us. All of those broader factors are in place at Q River. There's the water, the temperature, hydropower. It's a graded site. It's remote. It's secure. It's really interesting. So we think at Q River in particular, there's a real opportunity to create value there for our shareholders.
Peter, thank you for taking the time today to walk us through the Greenwing story and its diversified portfolio of critical minerals asset. We appreciate your time and we look forward to following Greenwing's next phase of development.
And I look forward to catching you over in Perth.
Me too.
Okay, thank you.
Thank you.